Hi there, I'm Tim MacKinley, the Chief Operating Officer at Quanta Investment Funds. Today we're in 157 Ann Street in the Brisbane CBD, and I'm going to talk to some of our leadership team about their key takings for 2025. But before we do that, how about we have a look at our major tenant here at 157, the EMF Performance and Recovery Centre. I'm joined now by Aron Bendell, our Head of Funds Management. Welcome, Aron.
Thanks, Tim.
Aron's our guru in all things debt, so we're going to get into some pretty hairy questions with Aron this morning. Aron, let's kick off. It's the $1 million question, but everyone has a view. So tell us your view on interest rates for 2025.
Knew that'd be the first question. If I had that crystal ball, I'd probably be retired right now.
True.
As most people reading the paper and watching the news and announcements from the central bank, you would have seen that historically they were looking at a February timing for the first cut. I think in reality now that has moved to probably the middle of 25. Most major banks have already moved their forecasts. NAB were the first to change. Westpac have also amended their timing for rate cut to June of 2025.
So, Aron, the sticky interest rates, acknowledging that some of the property purchases that we made were in that sort of late 2022 period where there'd been a big run-up of 14 quarterly percent increases or 25 basis points. What impact can that have on a fund like ours or funds like ours or any other funds out there?
Look, it has had an impact on the cash flows of the funds for the assets that were purchased in 2022. The funds you talk about, we actually had under contract and in control sort of in that early part, that sort of first half to sort of second half of 22. The first rate rise was actually May of 22. So the outlook at that particular time, even though rates had started to move, was far more moderate than the rates actually, than where they peaked at 4.35 at the end of 23. So that's had a sort of reasonable impact on cash flows. Fortunately, there's been some good work done on improving the cash flows and occupancy across a couple of the assets, but there's no doubt it has had a negative impact on the cash flows. They've also gone much higher than anyone reasonably forecast at the time. And when we were structuring those funds and looking at the cash flows, we were basing our outlook conservatively based off what the major banks were forecasting at the time. And all of the banks had it wrong for really 2 years almost. So it was a fairly difficult 18 months to 2 years that we've been sort of working our way through. I think reasonably we're sort of at the peak of that cycle. Probably limited prospects of any rate rises from here, I would think. But I think the timing of the first cut now is the thing that's going to be the unknown.
Aron, with all of that in mind, as we work through more acquisitions, the 3 at the back end of 2024, and we think we're going to have a big year in 2025, when you're looking at a forecast in the modelling that we do when we purchase, so that all things being equal, we provide a net distribution to our investors, what do you look at and how does that work in that model?
The core things that sit at the centre of the forecasting are reasonably what the major bank economists are forecasting in parallel with some of the language that comes out of the RBA, the central bank. So what we're actually looking at is what the average is between the highest and low, and then we're actually adding some contingency on top of that to provide us some level of contingency around the cash flows and distribution forecasts that we're actually setting. Clearly it's not an exact science, and there are always upside and downside risks to those forecasts. If rate cuts come in sooner, that's a positive impact to the net operating income and potentially has a positive impact on distributions that can be paid. The alternate to that is rates stay high for longer, or I would say that's more the case given I think reasonably we're at the peak of the cycle, or if rates did move again up, that would ultimately have a little bit of an impact on the forecast, but not significantly because we do have some level of contingency around timing for the first cut as well as the actual base rate that we're adopting.
Well, Aaron, as a lot of our investors know, we back our own investments. So a lot of the staff and management team are involved in that trust. So personally, I'd like to thank you because I did see all the hard work and you've done a great job, and we thank you for being with us today.
Thanks very much, Tim. Pleasure to be here.
Now I'm here with Stacey Jones, our CEO. Welcome, Stacey.
Thanks, Tim.
Stacey, 2024 it's turned out to be a really successful year for us, particularly with the last 3 raises that we've done. And we're looking like now 2025 is going to be one of high activity. How's the team feel at the moment in the office?
I think the energy among the team is fantastic. We've always been busy, whether we're buying or not. There's so much work to do around managing our investors' assets through leasing, project management, the day-to-day running. So we're always busy, but there's a different hum around the office when acquisitions are on. You know, there's the excitement and the challenge of something new, and the activity that we know comes from that, whether that be leasing or project management or a combination of those things, and the team gets really excited to sink their teeth into it. So it's been fantastic.
So just touching back on 2024, we've certainly built momentum, and as you suggested, when you once the activity increases, it seems to continue on. Then the support came, and we're very grateful to the investors. What's your sort of thoughts on what is out there for us in this year?
Look, we've already seen, because there are different assets that we've got under a different level of control as we move forward. So we know that there's going to be a strong start to the year and probably quite a few opportunities to follow that. Very importantly for us, I think we did a lot of work when there weren't properties to put to our investors. So engagement was really high when we first came back offering that first asset. So a testament to the support we're seeing now is the work we did in effectively what was a bit of the downtime. So we've got a lot that's coming ahead of us. There's going to be a lot that's going to be put in front of investors, whether they're existing investors of ours or people who may be new to us. There's going to be a lot of product on the market, lots of things for people to consider. We urge people to look at those really carefully. We're very strong on being transparent and open with our investors, so happy to engage. If investors are considering different opportunities and want to discuss those with us, we're more than happy to jump in and provide as much detail and commentary as we can around those things, because I think it's not going to be a case of there's only 1 or 2 things where you can put your money in this year. There's going to be a hive of activity from a wide range of investment managers like us and our colleagues. And so from that point of view, investors are going to be a little bit spoilt for choice, I think. So it's going to be time for them to be a bit picky on what suits their investment profile best.
Okay, great. And so in terms of the challenge we have, it sort of fits together with that response. Because we believe there'll be so many things on offer, the equity support's really important, isn't it? So is that what you would highlight as one of the challenges? Because there's such great opportunity to buy, and that won't last forever, at good yields and good returns for our investors. Do you see that as one of the key challenges?
Yes, there's going to be plenty of opportunities that we're going to put forward to investors, and we're going to do the homework like we always do, and like we always say, it's the ones that you don't buy, they're probably more important than the ones you do buy. So we will be backing those that we put to investors 100%. You and I personally will invest, the management team will invest, a lot of the rest of our team will invest in those. And so we'll be looking for investors to join us on that journey, but we know that there's probably going to be more opportunities than there are equity available. Yeah.
Look, thanks for being with us, Stacey. I'm looking forward to a huge 2025, and hopefully we can provide as many opportunities as we'd like to, good quality opportunities to our investors.
Thanks, Tim.
I'm here with Chris Carrigan today, Head of Property Investments. Chris, the last 5 months has been quite good for Quanta, but we'll talk about that later. We're going to cover a few topics. Let's talk about the 18 months prior to June 30 this year. What do we see in the market?
So across the market in all sectors, we saw very low transaction volumes. That was predominantly on account of a couple of things. There was a disparity between where book values sat for a lot of property owners and where real values sat. And then also the uncertainty around debt made it very difficult for transactions to take place.
So Chris, 2025 in our eyes looks like a good year coming up for for purchasing. There seems to be more stock around, or seems to be more stock coming to market. What should our investors be wary of when seeing other opportunities?
Yeah, well, definitely more opportunities will be coming in 2025, and that's because book values are now have parity with asset values. So people have written down their book value over the last 2 years. There's certainty in debt cost, so that's important for purchasers. And importantly, sellers of property now realise that the decline in asset value was not a temporary change, and they're going to need to deal with their portfolios now. And so we're seeing a lot of vendors bring opportunities to the market. They're priced at a level which is where we see value at. And so we're going to see a lot of transactions throughout 2025. I suppose the thing for investors to be wary of is that as people recycle their portfolio and manage their portfolio, they're going to get rid of the assets they don't want first. So it's really important for investors and certainly us. One thing we're very careful of is making sure we're picking up assets that have good fundamentals, good underlying real estate, and we're not buying someone else's problem. So that's one thing to really be wary of next year.
Sure, it makes sense. And Chris, our recent 3 transactions are since sort of July 1 this year. They've been off-market deals, and been private sellers, so it can take a little bit of that risk out sometimes of getting the bottom end of a portfolio.
The last 3 transactions are 1 fund manager, 2 private sellers, and they were all recycling through their portfolio for the same reason really, and that is to reduce debt, improve liquidity, but the assets were well priced. They had good fundamentals in terms of under-rented assets, good tenants, good underlying real estate. So they've been good acquisitions for us.
But message is still for investors to make sure you read those IMs in great detail.
Absolutely.
So Chris, you're laying the platform for a big 2025. What's on the horizon for Quanta? And maybe just if you could touch on the sort of 3 main sectors, industrial, retail and office, on your way through.
Sure. Well, across the board, one major factor that's going to be at play for probably the rest of this decade is the undersupply of new assets due to construction prices and financing costs. So new additions are going to be few, and that's really going to drive capital values of existing assets. So we think it's a really good time to be buying. In terms of sector specific, industrial, we think that finding under-rented industrial assets is key. So we are seeing a lot of assets, industrial assets that are 30 to even 40% under-rented. So really trying to find those assets that are realistically priced. Secondly, with retail assets, we think the opportunity is in under-managed assets that have problems because there's always capital growth when you fix those problems. And thirdly, we think probably the best value is Southeast Queensland office, despite really strong leasing markets and occupier risk being very stable. Office assets are just trading at very, very soft yields, which provides very good returns for investors.
So Chris, in terms of the next 18 months for Quanta, what sort of opportunities are you hoping to present to our investors?
So Tim, I think investment opportunities that we bring to investors are going to be strong distribution with a very compelling capital growth story. And to achieve that, we need to look at a few things. But really, as we've mentioned earlier, the under-rented story in industrial is very compelling. The value add in office and retail, it's really maintaining the discipline on what in our review and our due diligence of assets to make sure that we're buying high quality and that the value add scenarios we conceive are actually deliverable. And we're going to stick to that $30 million price point, which we think is allows us to establish good deal flow and realistic vendors. And I think we'll have several opportunities for investors over the 18 months.
Fantastic. Well, Chris, as the sun shines on our lovely 157 Ann Street asset in the Brisbane CBD, thanks for joining us.
Thanks, Tim.
I'm here with David Carpenter, our Head of Investor Relations. Dave, let's get straight into things. The investor engagement's a huge part of the Quanta business and has been since the day we opened the doors. Talk to me a little bit about some of the initiatives you put in place to keep our investors engaged.
Yeah, sure, Tim. So over the last 24 months, or since we came out with the Quanta brand, we spent a lot of time on our brand and awareness. So from a reporting perspective, that means we've implemented quarterly reports. They seem to have been really well received from our investors. The way that we can, realise that is the day-to-day inquiry has just reduced significantly over time, which to me means that we're putting out the information that is relevant to investors. Secondly, we've started doing an annual report. This is more for sort of our prospective investors and a broader market perspective on Quanta, giving us a little bit of an overview, I suppose, for all of the trusts that we have, what we're looking to do in the next coming 6 to 12 months. And we think it's a really good sort of piece of information that will give a really good indication about what Quanta is about and what we intend to do in the future. We spend a lot of time on website and our investor portal, both really good sources of information. The investor portal specifically provides a really good database of information for our investors. Again, everything from their distribution statements to tax advice, tax statements, I should say, all the way through to unit pricing. All those kind of things are all wrapped up within the investor portal. The QuantaCast has been a really good source of information for our investors. So that's our video podcast with yourself, Stacey, and Chris, of course. And that is generally based around our new acquisitions. So you go to site, it's a little bit of a debrief back in the office. Again, another source of information for our investors. We have a second part now to our QuantaCast as well, which is the professional series. And this is to bring in industry professionals that may be able to provide some additional information for investors to make an informed decision before investing within the commercial property space. In relation to our face-to-face engagement with investors, our investor roadshow, we love getting out to see our investors, of course, and these are generally towards the end of the financial year, start of the next financial year, and we go to Sydney, Melbourne, in Queensland. Because we're a Queensland company, it's easier for us to get out to, say, Toowoomba, Sunny Coast, Gold Coast, and these are generally smaller interactions with our investors, sort of lunchtime, around the table, and we find the engagement is really, really good. We get some really good feedback from these events.
Dave, kicking off 2025, we're in for a big year. You always do your annual survey around Christmas time. What are you looking forward to doing with that information you receive?
Yeah, the information has been coming back in good numbers from our investors, like always. We generally get good engagement for our investor survey, and it just gives us a really good foresight to investor appetite. What sectors they're looking for, distribution ranges, things like that. So those results will be with us shortly, and we'll provide those to investors in due course.
Excellent.